Is anybody else joining?
Actually, Mr. Parikshit and Sumit was available and he told me to join, but we will continue. If they did not join, I will give them the recording. It's not a problem, right? So, we have discussed about volumes in our last lecture, right? Volume is a number of shares or contract traded over a specific period, right? So if you are buying 100 quantity of any stock and I am selling 100 quantity of stock, then it will amounts to what is the total volume generated in the system if we made this 100 plus 100 stocks transaction.
200.
But actually we have traded only 100 shares. The buying of 100 shares from your side,
Okay, okay.
selling
Sorry.
from
Yeah, you
100
told this
shares,
the last
it will amount to 100 shares only, right? This is
100.
the
Yeah, yeah.
uh, misunderstanding that trader have, that the total trading volume will be the buying and selling plus, but it is not, right? So what does the volume tells us? Volume is a trend confirmation tool. Whatever the signal is generated by the system and whatever that system can be, right? System is nothing but the rules which we have formed to trade in the market, that on these rules, on the basis of these rules, we will trade and execute our entry and exits in the system, right? So what volume
Yeah.
tells us is that it gives you the insight. It gives you the insight of what other traders are thinking, how they want the market to move. It can be known by the volumes. Okay, the more active the share is, the higher would be its volume. This is the example of Amar Raja batteries, where you can see 100 plus 100 is not amounts to 200, it will amounts to 100 only for the volume scenario, right? And this is also same for the open interest too. And this is a volume table which is for your reference, that in any future case, that if you want to refer to that volume table, you can. uh, it says that when price is increasing and volume is increasing, the implication would be bullish. The total outcome of the market would be bullish. If the price is increasing and the volume is decreasing, means it suggests us a loss in momentum, a loss in strength. So it can be a signal of weakening a trend, right? Weakening of a direction of a trend, you can say. And when the price is decreasing and simultaneously volume is increasing, then it is showing you a good strength in a downtrend, a good strength in a bearish trend, right? And when the price is decreasing but the volume is not increasing, it is also decreasing, the volume is also decreasing, then it will be a weakening in the bearish trend, means a bearish trend can reverse from this point. or a point further in the future, right? Why the volume work? We have seen that in the previous chapter that when big players trade in the market, they have to take a large amount of shares or any asset, right? They do not buy in 100 200 shares. They buy like 50,000 shares or 1 lakh shares for a particular company, because they are a public fund or high frequency trading firm. They are having that much capacity to buy. So if any firm or any big institutional buyer wants to take a position in any particular stock, then he has to buy it in a staggered manner. Means they have to buy in a small amount continuously. They have to place orders at a higher and higher prices, and if they are selling, then they have to place uh, trades for prices lower and lower, because due to their activity, due to, let me bypass that thing, lobby. Right. So institute, when they transact that much quantity of shares in a particular stock or anything, it will tends to show up in the price and volume too. It will shown up in the volume that any big activity is going on in this stock, because the market is showing you a higher volume. Simultaneously, the price is also tends to increase, because they are buying in a very huge quantities. Okay, so if LIC wants to buy Cummins India, they will buy 50,000, 5 lakh shares at a time, and that 5 lakh shares are not available at a single price point, right? So they have to buy in a staggered manner, and that money which is flowing into the system is called as smart money, because they have more privileged, more advanced information, and they have some logical aspect. On the basis of that, they are buying, because they are putting their huge money in the market. So they have to be concrete in taking trades, right? They will take trades in a period of 2 months or 6 months. They do not trade regularly, so they are making good decisions. So it is very good choice to follow their footsteps, follow their footprints to make money as a retailer, because you and me do not have the capital requirement that we can move the market by 1 rupees, right? But these institutions, they can. So these type of activity of a big institutional player, these tends to show up on the volume table. You can see that what an institution is doing or not doing on the basis of volume table, that what volume table is implying. Okay, so you can see that the market has bottomed out at this point on a doji. A doji has been formed, and the doji is the red color doji has the highest volume generated. So this is also becomes a support resistance point, and we have seen that, and we have learned that these support and resistance exist because of the influx of buyers and sellers at these points. The demand and supply, the fight between buyers and seller tends to increase, and it will reflect in the volume too, that if a support is near or the market is bottoming out, the volume will give you more confirmation to it, right? So this has become a support, as you can see on this point too, that the influx of buyers and sellers are increasing, and this has reversed the previous trend, and take the prices sharply to the upside till now. Then a retracement, then the second leg up, right? So volume at this point, you can also see that the volume is tends to increase at this point, and the price is reacting from this price point. So this is how you can analyze that what volume will suggest you to do. It is a tool that add confirmation to your system. You can see a big volume spike on this chart and a doji candle. Mostly the doji candles have the highest volume because the demand and supply will be greatest at this price point, because there is a fight going on between buyers and sellers. So they want to take prices in their side, in their favor, and if buyers want to take prices to the upside and the buyers are strong, then they will win the fight and take the prices higher, and at this point the sellers lost, right? Their stop loss got hit. The sellers are weak hand in the market at this price point, because simultaneously a breakout has also been done. A breakout of this resistance trend line also has been done. So this might be the possible stop loss for the short sellers at this point. You have to know that how the price pattern is working. The first and foremost thing in the trading requirement is the price. You have to analyze that what price has been doing, and you have to know the trend, and in that trend find a trading opportunity in the direction of major trend. If the major trend is to the upside, then you should only find trading opportunities in the long side, buy position only in an uptrend. And if the current market trend is down, then you should only find short sell opportunities. So if you have sold at this point, let me ease. So this is the established downtrend, but the overall major trend is to the upside. We do not know the past, right? So at this point the chart is suggesting that the immediate trend is to the downside. This is the immediate trend, okay? And you have sold at this point, so you can easily book profit in the channel trend channel point. Always trends move, mostly the trend moves in a channel. If you are able to connect a trend line, a uptrend line connecting the swing lows, then most of the cases you can also connect the channel line, means the upper line which is connecting the higher highs. So the channel line will be the target for your trade. If you are taking a trade at this point, this is a channel trend line, and this is a support of this trend line, and simultaneously a breakout has been done of this retracement move in an uptrend. This is a retracement move. Retracement move is nothing but an opposite movement in the original trend. If the original trend is up, then the opposite trend will be a little to the downside, right? A bearish trend. So this is immediate bearish trend, and a breakout of this resistance trend line has been done, and you can see the price moves to the upside, right? So this is how you can use this. As you can see, the price is also increasing from this point. So this is a confirmation that this signal is good and valid. You can add a moving average in it too. That moving average will move like this. Moving average will move like this. So if the price crosses above the moving average, it has broken a trend line too, and the volume is also increasing at this point. So these three factors we have considered. You can add many more factors that support also has been there for a trend line, right? You can add four factors confirming a trade, or you can add much more in it. So if these all conditions are meeting, which you have pre-decided, then that signal will be more confident than one or two factors. So volume will tell you the influx of buyers and sellers and the insight of the market. This volume has, you can see, again the price retraced to the retracement line, to the trend line, and it again moves to the upside. And when the price moves to the upside in an uptrend, the volume is getting stronger. The volume is increasing. So that's how the volume shows you the signal. And this is volume consolidation with price, that the price is moving in a narrow range and the volume is also moving in a narrow range. If the prices break out of that range and simultaneously the volume also break out, as on this example the volume is increasing when the breakout has been done, right? At this point the breakout is done and you can see the volume rising, right? So this is a confirmation, and the market cannot be in trends for too long, means the market cannot stay in an uptrend or downtrend for too long, because it will eventually exhaust that trend, and at some point that trend will become a sideways range, or it will become a reversal, means it will become a bearish trend. Okay, so this rule implies to the moving average too, that the price cannot keeps above or below, far above or far below from the moving average for too long time, and it cannot stays at the moving average for too long time. It will deviate from the moving average, and if the price has been deviated, then it will again intersect with the moving average. And it is similar for the trends too, that if the prices cannot be in a trend for too long and the prices cannot be in a range for too long, eventually a range has to break out, and eventually a trend will become a range after some time in near future, right? In volume gauges the strength of the move. It doesn't matter whether the uptrend, whether it is an uptrend or downtrend, the confirmation signal is valid for both the trends. If a breakout is accompanied by high volume, then it is termed as a valid breakout. It might fail that breakout if volume is good, but there are possibilities that that breakout can fail, because we are dealing in probabilities and never in certainties. So in the long run, the probabilities of your setup will have to outrun these uh, failures, right? If you have placed 100 trades, then out of that, the ratio of your winning is like say 65. Then you can say that your strategy works for 60% of the time. In the long run, you have to backstretch that. Many of these strategies that would only work for 10% of the time, but their profit target expectations are much higher, and these 10 winners will outrun the 90 losers because their stop loss is very small but the target is very big. So it will depend on the strategy type, that what type of strategy we are using, right? And the probabilities will have to outrun in the long run. For the short term, anything can be a success or anything can be a failure in the short run. In the short run, you cannot guarantee trading as a successful or a failure. Okay, you have to check its implication for the long run. This is similar that if the price and volume do not match, means the price is increasing and the volume is not increasing, then it is your weakness in the trend. And the next topic for today's session will be chart patterns. Okay, there are some chart patterns which form over and over and over again and again on the charts, and these chart pattern formed because of the psychology of the people. These charts are visual representation of the traders behind trading behind the market, right? uh, it shows the mindset of other traders, that what they are thinking, what the mass traders are thinking in the market right now. And these patterns occurs repeatedly in the market, and they have a successful probabilistic winning ratio, because these and they works because the rule of history repeats itself. History always repeats itself. It doesn't matter how it will be reacting in the present condition, but their implication will be almost same, right? So we have discussed about what a candlestick patterns can be, and there are only two types of candlestick pattern. Candlestick pattern, first one is momentum candle, and the second one is ranging candle, or you can say trading candle, right? So that candlestick patterns are formed by using one candle only, and these chart patterns, these are formed over a period of time by combining many candles on the chart, right? So they based on the premise that history repeats itself. And what is a chart pattern? Chart pattern is a shape, a visual representation, as I said, a visual representation of price that helps to suggest, they are only suggesting you that these has happened in the past, and again in the present this type of pattern is forming on the chart, and it might be the implication of that pattern, right? So it suggests that what price might do next. It only suggests that what price might do next, because we are always dealing in probabilities and never certainties. So this is just based on what have been done in the past, and we are using that past for our present trading requirement. And these are pure price action charts patterns, uh, they works well than most of the indicators which we have discussed previously, but they are a little hard to identify because it needs a little eye exercise that you have to identify thousands of triangles before you trade them successfully. So, and each and every triangle forming in the present or in past, they will not be exactly the same. They will be similar but not exactly the same, because every market condition, every market scenario will have something in different. As we say that each day in the market is different. There is no similarity on the previous day. What the market has done on the previous day, it might not. There is no guarantee that it will do in the present too. Right. If you can analyze the recurrence of identifiable patterns, as I said that they are patterns which form again and again over a period of time. Okay, so and their reoccurrence are also high, and there are many types of chart patterns, but we will discuss the major chart pattern which are proven to be have a successful ratio, and they reoccur most of the time in the market, and they are very easy to trade, right? So once you learn the price action chart patterns, then you do not need other indicators like RSI, MACD, or moving averages. Also you do not need, but the volume is an integral part of price action. The volume is not an indicator, but integral part. It is a basic requirement of the charts, right? So the volume is needed for chart patterns. You can combine the RSI and MACD with it for more confirmation signal if you want, but you can trade a naked price chart pattern without any indicator. So this says if you can analyze the reoccurrence of identifiable patterns and formation that have preceded, means what have done in the past or accompanied important market movement in the past. That this type of movement has been done in the past. If you know that, then you can use that information to get important clues and important opinion that what the market will do in the future or what the market might do in the future, right? So there are some type of chart patterns. Why there are types? Because their implications are a little different, and these chart patterns are, you can say, the market behavior is, there is type of market behavior in which this price pattern works. So the current market situation is continuation pattern, right? The market is falling for the last 2.5 months, I think, and the any pattern is forming, it will leads the price to move in the original, in the direction of original trend. If let's say on 5th April, you will see that the bank nifty and nifty has formed this type of range, and everyone was thinking that it will break to the upside and make a new lifetime high. Nifty and bank nifty both will make a new lifetime high on 5th April. But the what market has done is the market has reversed sharply from this pattern. So this is the top. The previous market trend was up. So this is the top. It has become a reversal pattern. It has become a reversal pattern. So this is the first type. that the reversal chart pattern. This is a rectangle pattern. You can see, you can identify this range as a rectangle range. Uh, this is a play of support and resistance. We have learned that in the support and resistance topic, that you can buy at point A and sell at point B, or you can short sell at point B and buy it again at point A. We will discuss in further, but just see that if trend the current market trend is up, and if it is changing to the downtrend, then these type of pattern is reversal pattern, which occurs at the top or the bottom of a trend. And let's say again the price fall at this point, and the price has formed a triangle pattern at this point, right? And the breakout has done to the downside again, so this has become a continuation pattern. Why continuation? Because it is continuing. This is the first leg. You can see, you can say that it is a first leg in the first downtrend, and this pattern is a little pause. This is pausing the market for a little while. It has halted the market and made this trading range at this point, and it has again breaks to the downside. And what the previous trend was, it is downtrend, and again the price is moving down, so it has become a continuation pattern for the market, right? So there are two type of chart pattern: reversal chart pattern and continuation chart patterns. Okay, we will discuss the most reliable and most reoccurred price pattern only. Otherwise, there will be like 200 or 300 type of chart patterns too, but they are not easy to find out. These other type of chart pattern, they are not easy to find out with our naked eyes. Uh, algorithmic computer can find that patterns, but it is not important to learn all of these type of chart pattern, but to master some of the chart patterns to trade successfully. Okay, and these chart patterns which we'll about to learn will have validity of giving profit or repeating its nature for over a many years of period, right? So reversal pattern we know, and continuation pattern. So let's get inside that what reversal patterns are. So the first type in it is head and shoulder, double top and double bottom, you can say, rounding top, rounding bottom. We will see these all in detail. Okay, and these are some major continuation patterns: flags, ascending triangle, descending triangle. And these triangles can be reversal patterns too. We are seeing that this is continuation, but as I said, that there is no type of continuation pattern or reversal pattern. There is no type of chart pattern. This is just the type of market behavior in which we currently are, right? We have to see the price, which is always be supreme. There are these three type of triangles, then there is pennants and rectangles, and there are some wedge patterns. Okay, so these names will be a little confusing for you, but once we discuss it in detail, you will get clear of that. uh, this is a theory of what a reversal pattern is: a price pattern that signal a change in the prevailing trend. Means the uptrend, the previous trend is uptrend, a halt, a pause in the market, it has formed a trading range, or you can see a rectangle formation. And if the price breaks to the downside, changing its previous trend, the price is changing its previous trend, prevailing trend, then it is a reversal trade. The reversal can be like, if the current market trend is down, a range to the bottom, any pattern this can be, and if the price break out to the upside, then it is also a reversal. This is a bullish reversal it has become, and on the top side it will become a bearish reversal pattern. Okay, so some points that are needed to consider when we are identifying and trading a reversal pattern. The first one is existence of prior trend. We should You have to look at the previous trend, that what the trend is the previous trend, the major trend is up or down. Okay, then you have to see the pattern which is forming. Is it a wedge pattern, it is a triangle pattern, what type of pattern is forming, and see that if the market is previously in an uptrend and a triangle pattern has been forming, then which type of pattern it will be in the future. So it will be known on the breakout only. You cannot get signal before a breakout happens, right? If you can see, if a resistance is there, a big resistance is there at this, at the formation of this price pattern, then what the implication will be known only on the breakout, that the sellers dominate this trend and take the prices lower, or the buyers will take charge and take the prices higher. It will known on the breakout of this pattern only. Okay, so the first signal you will get when a trend line has been broken. Okay, if the current market trend is up and if this trend line has been broken, then this is the first signal that a trend might reverse. This uptrend is losing its strength. This is the first signal you will get. And the second point, the third point is that the larger the pattern is, the greater is the subsequent move, and the longer it takes to form, means in duration. If a pattern is forming for, let's say, 1 hour, and similarly a pattern is forming for 1 month, then which pattern has greater significance, a 1 month pattern or a 1 hour pattern? Of course, the 1 month pattern has more significance to it, right? And the higher the time frame for a pattern, the more significance it has. If a pattern is forming on 5 minute chart and similarly a different pattern is forming on 1 day time frame, then the more weightage and more significance will be for 1 day hour time frame pattern, because the more efforts has been done by the traders to form that pattern, right? So this is just a general rule. You do not need to remember that. Topping patterns are usually shorter in duration. Means when the prices is moving higher to the upside, then whatever the pattern is forming at the top, so these top patterns on the top have shorter duration in formation. Okay, these pattern forms for a short period and the price fall sharply in a small duration. But when the price is moving to the downside and this type of pattern is forming, they will take a higher time frame and higher duration a longer duration to form it will take. And on the bottom side, the price movement means if the price is moving in a range, then this range will be shorter, means the range is untradable. This type of range, the price movement is very shorter, but their duration is very long on the bottom side. But on the top side, the pattern forms for a shorter duration, but their movement is very high. Okay, their movement is big enough to trade in between the range. Did you get that? This is just a general rule which a trader has uh, identified over a period of time by identifying some thousands of patterns. Okay, so topping patterns are usually shorter in duration and more volatile than the bottoms. And the bottoms have smaller price ranges and takes longer to build. Is it clear? If you have any doubt till now. Okay, and this is the significance of volume. That volume is much more important on the upside breakout when whatever pattern is forming and it is showing you an upside breakout, means the price is about to rise. Whenever the price is rising, it needs a higher volume, because whenever you are writing on a board, uh, it needs a certain period of time which is required to write on the board. But to erase that board, whatever you have write on it, and the time required for erasing that thing is very less. Okay, you have to take 15 minutes, 20 minutes to write a full page, but it takes only some seconds to tear it apart, right? So that's why the volume is very important when you are expecting a rise in the prices, because fear spreads faster than greed. Okay, do you have any doubt till now?
No, I'm good.
Okay, so the first type of reversal pattern you can say, or continuation pattern you can say, is head and shoulder pattern. As the name says, head and shoulder pattern, what it means is that you can identify a head and shoulder on this pattern. These
Yeah,
chart
the
patterns,
top one is the head.
this is the head, right? And these two are shoulders. So many of these patterns are named on their visual representation only. If a triangle has been forming, then that pattern is named as triangle. And if a rectangle range is forming, then it is named as rectangle. So they will be very easy to remember, right? So what is the implication of head and shoulder, right? Head and shoulder pattern is a bearish reversal pattern. They usually occurs at the top of the trend. right? And it starts from a small price movement, means the current market trend is up. You can see the current market trend is up, and a retracement move, and again the prices moved higher, right? Till now we do not know that a head and shoulder is forming, right? But the retracement move comes in, and the retracement move has near the made a low near the previous low, previous swing low. This low is near this previous swing low. This low can be a little below or a little upside too. It doesn't matter, because this is just an illustration. In the real market, the pattern might be different, right? So the price was in an uptrend, and a big retracement has seen. This down move is a big retracement move. This is not normal. So the first signal we have generated that a retracement move is bigger than the previous retracements, right? So this might be a weakness in the trend. This is the first signal we are getting in this chart, and this is the first logic. And then again the price started to move to the upside, but these price failed to move above the previous high. The price refuses to move above the previous high, means this is the second signal that the price has made a lower high. This high is lower than the previous high. So this is the second signal we have seen, that signal trend is losing its strength, right? And you can see by connecting these two lows, these 2 points, you can form a neckline. Okay, this line is called a neckline. This is shoulder 1, this is head, and this is shoulder 2, and this is the neckline. So how to trade a head and shoulder pattern is to place a trade on the breakdown of neckline, a little points below the breakdown of neckline, right? And you can use a stop a little above your entry price, or you can place a stop above the second shoulder. These two are the stop loss point in this pattern. Okay, so the head and shoulder is a bearish reversal pattern with a neckline and three peaks, two lateral peaks, means three peaks. It needs its is three highs. This is the first high, second high, and third lower high. Okay, this is simply logical that the price is showing a weakness in this trend, and the price unable to make a new high, so it is losing its momentum. So it is good to bet on the downside only. It is good to short sell from this point. And when you are able to draw a neckline, then the pattern has been completely formed. Just you have to take an entry when the price breaks the trend line. All right, this is the illustration. You can see that this trend line is identifying an uptrend in the market, and a big retracement has been come in the head zone. You can see a big retracement has been come, and the price refuses to make a new high and breaks its trend line, so neckline. So the neckline is, the neckline slopes can be anything. It can be exactly horizontal, it can be a slightly upsloping, or it can be a slightly downsloping. So it doesn't matter. So the neckline is neckline, but you just have to see that this low should be near the previous low. A little bit can work, but not too much, right? And the price is starting to make higher lower highs. Sorry, the high is lower than the previous high. And the third point in this head and shoulder pattern is measured move. So after a breakout of this neckline, what would be your profit expectation? What is your profit target? This profit target is also hidden in this pattern only. Okay, you can see this dashed line. Okay, this line is measuring the distance between the head, the top of the head and the neckline. So if you measure this height and project this height at the breakout point, means you can just copy this line and paste it here. So this will become a measured move. What measured move is that we are assuming that price always repeats itself. The history always repeats itself. So whatever the movement which has been done in the past will again occur similarly in the present too. There are some probabilities to it. So you can use a measured move target. This is we call a measured move, and this is very important because this is applicable in like 20 to 15 type of patterns which we are about to learn. This is all similar. Okay, and the fourth thing you should see is the volume at the breakout point. You can see the volume is rising when the price is moving to the downside. Although the significance for volume for a downtrend, for breakdown of price, is less important, but if you are considering volume 2 for the bull breakout or bear breakout, it will be uh, giving you some validation to your pattern, right? So the first thing is uptrend, and the second thing is losing strength in the uptrend. The third is forming of neckline. The fourth thing is entering on the neckline and taking a target of measured move. All right, and you can see that at point G, this will be the fifth point in our learning. Point G. What this point G is, when the price breaken down from this neckline, price fall a little bit without hitting our target, and the price again moves back to the neckline. This is we have learned about retest of the price, that most of the time, 80% of the time or 70% of the time, prices do make a retest move, means to validate this pattern, to validate this breakdown, and to many of the players are left, means they do not take the entry at this point and they want to get entered into this short sell position. So what they do is, the price moved to this point down, then they started to buy a little bit. So a little buying opportunity, and some uh, short sellers which have short sell, aggressive short sellers which have short sold at the head point or at the right shoulder point, they will book their profit, and some wants to enter new short position in this pattern, so they will create a retest. So this G point is a retest, breakout retest, and if the retest gets successful, means the price respect this level and again reverses from this point G, from the neckline for the second time. The first time is breakout, and for the second time, when a breakout has been done, oh sorry, a retest has been done. So this is a confirmation, plus it is entering new short position. So this is a addition in confirmation that the price will move to the downside. You can bet a short sell position at this point, or you can bet a short sell position below the low of this breakout, right? But when you place a trade at this point, your stop loss will be very higher at this point, or if you are safe, then the stop loss would be point E. Okay, and there are some traders who are placing a stop loss order above the head too. Okay, are we clear on the head and shoulder pattern?
Yeah.
Okay, let's see it on live charts. Okay, so on the live charts, these patterns will not be identified as we are learning in the textbook. What we have learned is the textbook theory patterns, right? But on the real market, they might be a little difficult to identify. That's why you have to practice by identifying many type of these patterns to get familiar with them and to identify them easily. Okay, so is this pattern related to head and shoulder pattern? This pattern can be a head and shoulder pattern, right? Because this is the first shoulder. Okay, draw a line, and you can see this is a head which is a higher than the previous high, and then again a high, means after this candle the price tries to move to the upside, but it refuses to form a new high, and the price is unable to form a new high. And at this point you can draw a neckline by connecting these 2 points. Okay, these 2 points are connected, then you can draw a neckline, this green color neckline, and you can see on the breakdown point the price sharply moved to the downside and a retracement point move has come. A retracement move is get successful, the price respected this breakdown level, and the trader wants the price to lower. If they retest gets failed, then the price will continue to move to the upside, and most of the time most of the traders got their stop loss hit. Okay, if the retest gets successful, then traders will short more and more at these points, because this is adding confirmation to their signals. All right, and as you can see on the breakout point, the volume is also spiking. This blue color line is a average volume, so the volume is way above the average volume. This is the shoulder, head, shoulder, and a retest. Okay, you can see that this is also a head and shoulder pattern. This is the left shoulder. The price is moving in uptrend, and these uptrend got exhausted because of this big retracement. This is the biggest retracement than the previous retracement. See that in the past, the previous retracement moves are not that much bigger. You can see, right? But this retracement move is double than the previous retracement moves. So this might be a retracement, not a retracement, but a signaling of a trend reversal. Right. This is the first signal, and the second signal will be the price refuses to move above the previous high, and you can see a breakdown from this price point. This is a container corporation on a 5-minute time frame. Right, and this is just, we can say, second side of a same coin. Right. This is just the inverse of what an head and shoulder is. Okay, this is we called an inverse head and shoulder pattern. This type of pattern occurs at the bottom of the trend. Means the implication for this pattern is bullish. This pattern tries to take prices higher, right? And this is occurring at the bottom of the trend, and the previous trend should be downtrend, right? And this downtrend is losing momentum when you have seen this leg that the price has moved to the upside for a significant amount and for significant price, right? So, and the price also refuses to make a new lower low, form a new low. This is the lowest low, but this low is not lower than the previous low. So this is showing a weakness in the bearish trend. The bearish trend is getting weaker and losing its strength. So you can place a buy order on the breakout of neckline. This is just opposite, exactly opposite of what a head and shoulder pattern is. Okay. Once you learn head and shoulder pattern, then there will be not a problem to understand inverse head and shoulder pattern. Okay, this is the opposite and indicates a bullish reversal. Means its implication is the price should rise, and inverse pattern head and shoulder formed when the price falls to lower low in a downtrend, but then bounces and finds a support roughly at the same level as the first floor. On the neckline breakout, you should buy with a stop loss of this, or a stop loss just below your entry, or a stop loss of head. Okay, uh, for a moderate trader, the stop loss of this shoulder will be enough for a short term trader. Right, any move below this point is a fake breakout. It will amounts to a fake breakout, and the price will resumes to the downside. these type of scenarios can happen. That's why we are putting a stop loss, right? Because we do not expect each and every trade to get successful. How or whatever we are including the factor, and how much, it doesn't matter how much confirmation we are adding to a scenario. You cannot get 100% accuracy in any system. This is all probabilities. So you have to keep that mindset of probabilities initially when you start trading. You cannot be, you know, too much resistive when refusing to take up a loss. If you learn to take loss, then you will succeed in trading business. Right, so this is just illustration. You can see all the things similar of what an head and shoulder is. The existence of prior downtrend, uh, neckline has been formed, the price refuses to move to the upside, sorry, to the downside, means it is losing its momentum. Price is refusing to make a lower low, and it breaks its neckline. If you want a higher accurate results, then you should always wait for a retest, because 70% of the time the retest happens. So it will be a wiser to wait for the retest and get into the trade at this point, somewhere at this point, because the retest is adding you more signal to the confirmation. And you can see after the retest to the price, the volume moves higher. These are volume bars, right? You can see on the chart that the slope of the neckline can be a little down slope, a horizontal slope, or it can be a uprising slope. It doesn't matter. The implication will be similar, right? So you have to see the condition. Uh, the pattern is required. So the condition is, I am again and again repeating, if the condition is the price is moving in a downtrend and the price has a significant retracement in the opposite direction, and the price refuses to form a lower low or higher high in case of uptrend or lower low in case of downtrend. Okay, take entry on the breakout or wait for the retest and then enter. Okay, so in this scenario the retest does not happen, but 70% of the time retest happen. Are we clear about head and shoulder pattern and inverse head and shoulder pattern?
Yep.
Okay. And the second type of reversal pattern is double top pattern. Okay. You can see on this illustration, double top has been formed. Can you identify that? Double top pattern is a price is moving in uptrend. Okay. The previous prior trend is uptrend and the price formed a high and again it retraced a little bit. This is a retracement. Alright. After retracement, it moves to the upside, but it again reversed at the price zone near the previous high. It might not be the exact price level, a price point. Okay, it is a zone that in this zone the price has again reversed for the second time from this zone. So if you can identify two highs at a similar price zone, okay, not a particular price point but a similar price zone, then a double top pattern has been formed, right? When you identify these two double tops, the retracement move means this move and this move should not be much bigger, like the double top should not be this much big. Okay, the range between the this low and these two highs should be moderate. They do not be too much shorter or they do not be too much bigger, right? They should be moderate in their nature. So first top, second top, and a neckline has been formed by drawing a horizontal line at the low of these two tops. Means this is the point where from where the price reversed. Okay, so this might be a support and resistance point. So the implication for trading this pattern is to trade when a breakdown has been done of the neckline for the double top pattern, right? This is the illustration. You can see uptrend, okay, and the high has been formed. We do not know at this point that what the price might do. The price reversed, took a support of the trend line, the original trend line. The price took support of this point and it moves higher, but it has not able to cross the previous high, which is point A. It has not able to cross and it moves to the downside, right? So we can draw a horizontal line at this point B, and this is the first signal. As we have learned re as we have learned that reversal, the first signal in reversal is breakdown of major trend line. So this is the first signal that is showing a reversal might happen. This is just the first initial signal. So this is a signal a trend line has been broken and your entry point will be the breakdown of neckline. Okay, you can enter here but the risk would be higher at this point because many of the time the trend line gets broken by some points, then again some buyers came in and they take the prices higher, right? So it is wiser to wait for the breakdown of neckline, and you can wait for the retest too and measure the distance between the top and the low which has been formed during this pattern. You can measure this point and project it at the breakout point. So typically the market has tendency to move, give a measured move most of the time. Okay, so this is your minimum profit expectation. The If you are seeing that the trend is getting very weaker at this point, your target should be bigger, then you can increase that, you can trail your stop loss. Okay, but this is measured move is the minimum profit objective. Double top is a bearish reversal pattern where the price reaches a high two times and it enables to break higher on the second attempt. Okay, mean if what is saying is that the price reaches a high and again it reaches the high for the two time and unable to break the higher on the second attempt, means the second attempt is not able to break this previous high and again reverses. So this has become our neckline. Okay, and this is your entry point. These pullback, what pullback is, this is, these two moves are pullback. These two should be moderate, they do not should be very small or very big, because if the pullback is very big, then it might be a chance that you are getting a very late entry in this trend, right? And if it is very short, then there are many chances that this is a false double top, right? So the pattern is confirmed once the price breaches the low of the pullback between the two tops, means the neckline breakdown. This pattern is most frequently recognized and easily recognized and most frequently occurred in the market. You will see most of the time at minor reversal or major reversals, many of the time double top pattern will be forming. Okay, and the volume is usually light on second peak, means this is the first peak, a pullback, and and when the price is moving, means in this leg the volume is very less. In this up move the volume is very less. The price formed a double top and then it moves down, and at this breakdown point of this neckline the volume tends to increase. Okay, on a breakout, whatever a breakout is, the volume should increase, whether it is a bearish breakout or it is a bullish breakout. Every breakout needs some major participants, many orders, to move in a momentum basis, right? The minimum measuring target is the height of the top and breakdown level, means the height of this top and the pullback low. This is the minimum target objective for you. You can see on the live chart example that how these patterns work in the real charts. Okay, they do not tends to be exact at what the price is doing, what the patterns are showing on in a textbook example, in an illustration. They will be a little patchy, they will be a little choppy in the real market, because these, as you can see on this breakdown, the price moved a little lower and a retest. Okay, so if you are using a stop loss just exactly above the neckline, then there are 80% chances that your stop loss get hits, because the neckline is not an exact price point. If you can see, the neckline is at 220, price 220. Okay, so the 220 is not an exact neckline point. uh, it is a zone, you can consider. This neckline has a zone. Okay, these, every support resistance or every significant price point is not a exact point on the chart. These all are a general zones. All right. So you have to give a little space to price to breathe in, right? So this type of movement can occur, but any weak hand, any person who is trading out of his pocket, quantity out of his pocket, means what he is afford to lose, he is trading more than that, then he will get panic at this situation and he will exit his position in loss at this point. But the overall market movement is down only, and you can see the big profit expectation, and you can see the measured move. This is the measured move projected at this point. You can see it has been achieved. Okay, so I will recommend that you should use whatever the measured move target is, whatever these measured move is, you should use a little less for your target, right? Because there might be chances that you are entering a little late, or you are entering, uh, you have drawn a wrong neckline, or whatever it can be. So if your measured move for this pattern is, let's say, 10 points, then you can use 7 points or 8 points as your profit target to get exactly precise, right? Similarly, this is a double bottom pattern. Double tops occurred at the top of the trend, and double bottoms occur at the bottom of the trend. This is just similar, like head and shoulder and inverse head and shoulder. This is also similar, right? In this pattern, you can see the price refuses to go below, form a new lower low. The price refuses to form a lower low, and a neckline has been formed after a pullback. This is a pullback and again a trend resumption, but this has failed, and price successfully breaks out above the neckline. This neckline, you can enter here. This is a sharp reversal pattern, right? Illustration: the measured move implication, the volume implication, and the retracement move implication, these are very much similar. Double bottom is a mirror image of double top. Under the double bottom is bullish reversal pattern, where the price holds a low two times. The price is refusing to go below from a certain price zone for the two times, and it successfully breaks out above the pullback high, means the neckline, and on the breakout of the neckline you can enter long, and the bounce between, means the pullback between that double bottom, should be moderate. They should not be very bigger or very shorter. Volume is very much important in the upside breakout, because it took way much time to write on a paper than to tear it apart or to erase it, right? You can see on the chart that the exact double bottom pattern has been recognized, and on the breakout of neckline, you can see the sharp up move. The measured move target is the minimum objective, and you can see the volume 2, it is increasing above average. So this is a confirmation for your trade, right? And it sharply moves to the upside, and the measured move target is easily achieved. Okay, this is ITC limited, and you can see the measured move is also near the previous swing high, right? So it is wiser to book a little below the previous high or at some point here, and if you are seeing that this high is easily taken out by the price, then you can wait for some much more further target with a trailing stop loss. Okay, as the double bottom and double top patterns are, there is triple top and triple bottom pattern, just similar to double top and double bottom. Instead of two peaks or two, means two highs or two lows, the price is forming three highs and three lows. They do not occur that much. Okay, their repetitions are a little less than the double top and double bottom, but it is good to learn, right? They are rarely found, not too much rarely, but they are hard to find, because exactly matching three lows at a similar point, or a neckline, two lows, three highs at exact point, exact zone, and two lows, two pullbacks at a similar level, it is very hard to find. It is simply a trading range, you can say. This has become a trading range, right? So this we will cover in rectangle formation, how to trade a rectangle formation. The profit expectation, the measured move is also similar. The pull retracement move is also similar in all of the patterns, most of the patterns. The volume implication, you can see on the breakout, the volume is tends to increase at this point. Okay, let's see on the live charts, real charts. Three tops have been identified. This is the first, second, and third. And similarly, these lows are also at the same point. Okay, so they are little hard to find, and a breakout has been done, breakdown has been done till this point, and you can see the retracement move, the retest move. It is a little bigger than the neckline, means the retest cannot be exact, they will have some noise. Okay, and this is just simply a trading range. This is, you should use this pattern as a trading range or a rectangle formation, so you can use trade accordingly. I will describe you what how to trade successfully a rectangle pattern. Okay, and this is the profit expectation which I have calculated and projected it here. You can see how beautifully it has achieved by a wick. If you have put your order in system for the target, then see how it has been hit by the price, right? So that's why the market tends to move in a similar movement than what it has moved in the past. Similarly, triple bottom pattern. In this, you are seeing three lows at a similar zone and a neckline of two pullbacks. Okay, entering at the breakout of this point. or you can wait for a retest. Right, this is live chart. Your profit expectation has been achieved at this point, right? The measured move between the low and the neckline will be your profit objective. This is your minimum profit objective of a difference between the neckline and the low. Okay, so if you have any doubt, ask. We have covered the major reversal patterns that reverses its trend successfully, and their repetitions are very much higher. Okay, if you have any doubt till now, you can ask me.
Hi, Sanjay.
Hi, Prakash.
Actually, I have a doubt. What is the time frame? Actually, in the chat, it's showing is 1 hour. Can we take a 1 hour or 30 minutes or a daily time frame we can take
Whatever you want,
to identify that
whatever you want.
whatever you
You
want?
can see on this chart the Jubilant football that it
Okay.
is on 30-minute time frame, right? So, and
Yes.
previously we have seen that ITC Limited has 1 hour time frame. Okay.
Yes. Yes.
So
Yes.
the implication of what we are learning is it has implication from 1 minute time frame to 1 month time frame. It
Mm.
will be all be similar. They do not change.
Okay. Okay.
Okay. But
Okay.
your
Okay.
trading style, according to your trading style, you are choosing your time frame. Okay,
Time.
and
Yes.
your
Yes.
profit objective and all will change according to your time frame. Okay, if
Okay.
you are
Okay.
getting a 100 point movement in this measured move, right, then on a
Okay.
15-minute time frame these move will be only for 10 points, right? So you
Okay.
are
Yeah. Yeah.
trading for a shorter period of time for a smaller
Mm.
target on a lower
Okay.
time frame, right?
Okay. Okay. Okay.
Yeah. Any
Yeah. Thank you.
anything else?
Nothing. Nothing.
Okay.